In this video, we are going to talk about the external section of the VCE Economics. We are going to discuss the relationship between trade and living standards, as well as the accounting system with regard to international trade, which is called the balance of payments. We will also look at the causes of Australia's historical current account deficits, and also discuss the related topic of net foreign debt and equity. So first, what is the relationship between trade and living standards? So the first benefit, so usually when we talk about trade or international trade, it generally increases the living standards. So what is the reason for that? So the first reason is greater choice and lower price. So if you think from consumers' perspective, the international trade allows them to access high quality or cheaper goods and services than the Australian-made product. So what is the reason behind this? In foreign countries, especially in developing nations, their labor cost and electricity cost and cost of land is much cheaper. So they can produce the same amount of products for a much lower price. And with international trade, the Australian consumers can indirectly enjoy the benefit of cheap labor in developing nations. And also, international trade allows the flow of high quality goods and services as well, so such as luxury cars from foreign countries, as well as the intellectual properties that are developed in foreign countries. So it allows consumers to enjoy a greater range of products. So this can cause increase in purchasing power due to lower price. And also, because of higher purchasing power, as we have discussed in the previous video, this can lead to increase in material living standard. And also, since you have access to a greater choice or greater range of product, you can improve the quality of life. Or enjoyment, because you may not have this much choice or this much access to goods or services without international trade. And this perhaps can increase the non-material living standard. So the next reason why we want to conduct trade is because of access to more factors of production. So I will abbreviate factors of production by FOB, so factors of production. So factors of production relates to things like land, labor, or capital. So international trade allows us to source capitals such as semiconductors or machineries from overseas countries. And it can also attract skilled labor or just foreign labor in this process as well. So if we can increase the factor of production, and specifically if we can increase the quality, which usually is imported in the form of capital, as well as the quantity, such as a more highly skilled labor force or a large supply of labor. But this can, if you can increase the quantity and quality of factors of production, this, as we have already discussed in the aggregate supply video, can decrease the cost of production. and shift the AS curve to the right. And this means we have a higher productive capacity. So the economy is able to produce more. And this is good for the long-term development of the economy. The last factor of why we want to conduct international trade is called the economies of scale. So this is an economic topic, but also related to accounting. So in accounting, there's a term called fixed costs. So those are costs that are going to incur regardless of whether you make a product or not, or is independent of the quantity of goods and services you produce. So this includes things like rent to landlord. So suppose you have a factory and then you rent the factory. Regardless of whether you produce anything or not, the rent per year is fixed. So that's why it's called a fixed cost. So a property of fixed cost is that if you increase the quantity of production, the fixed cost per unit of good will decrease. So this concept is really important. So it is fixed cost per unit of good. So it is not the overall fixed cost that is going to decrease. It is the fixed cost that when you spread to individual product that is going to decrease. The overall amount of fixed cost should be the same. Another example of fixed cost is the cost associated with research and development. So if you have developed a new medicine, no matter you produce one package of the medicine or you produce 1 million package of the medicine, you have already incurred the research and development cost. So it would not change. But the per unit cost due to research and development is going to decrease if you produce more quantity of that medicine. And this can increase the price competitiveness of Australian good. So this can encourage more export because locally made products becomes more competitive. So that's the reason we want to conduct trade. So next, let's have a look at the accounting system of trade. So this topic called balance of payment is really a confusing topic for many students. So many find it very difficult to understand. And I think the reason is because it is just an accounting system. And unlike things that occurs naturally in nature, accounting system is something that we created. So it's human creation. And that's why that sometimes it may seem a little bit counterintuitive. But if you think of this as something that is just created by us in our brain, I think it can help you to understand this better. Rather than trying to really make sense of what is going on, just accept that this is how we defined the system to be. So it is separated by into two major components: current account, and on the right is called the capital and financial account. So current account, the definition of current account is something that is current in nature. So by this I mean that it records transactions or things that do not carry future obligations. So that's why it's called current. So only the liability or assets is only there for one period only, so it have nothing to do with the future. Once it is settled forever. For capital and financial account, it records things that with future obligations. So what are the things with future obligations? So if you have a debt, it carries future obligations. Maybe the debt is a 5-year bond. So you are obliged to repay the interest and principal of the debt for 5 years. It's beyond the current period, which is only 1 year. So that's what I mean by future obligations. Or equities. So shares is also a future obligation because you need to pay shareholder some dividend indefinitely into the future. So of course, the liability is beyond this year or the current period only. Balance of payment is separated into these two major components. And the two major components is further divided into sub-accounts. So there are many sub-accounts for current account. So it includes net goods, net services, net primary income, and net secondary income. So I think for net good and net services is easier to understand. So it is just the familiar export minus import. So if you have exported $50 of a product during this year and you have imported $100 of product, then the net good component is negative 50. So this is something that we are familiar with. And you know that it is current in nature because once the buyer receives the product and the seller, which is Australian businesses, receive the money of this product, then this deal is completed. So it does not have any future obligations. Once the service is provided and the amount has been paid, then this whole contract or this whole services would come to an end. So there's really nothing to do with future obligations. So that's why they are in current account. And net primary income, it's something to do, so this is the payment of dividend and interest on debt. So you might be a little bit confused now. So I have discussed that in the capital account we have debt and equities. And interest is related to debt. Dividend is related to equities. So why is they both simultaneously in the capital account and also in the current account? So we need to distinguish the difference between, let's use debt as an example, between debt and interest. So debt is the amount of money you have borrowed. And interest is your repayment or compensation for lenders to lend you money. So they are related but different topics. So you borrow the debt and interest is calculated with respect to the debt. So it is the debt you have borrowed that carries on a future obligation. But the interest payment itself is not a future obligation. Because once you have repaid interest in that period, so let's say that in this year, you need to repay $5,000 of interest. Once you have paid this year's interest, it is all good. So in this year, you do not owe anything to the lender. But for the debt, because it is usually more than 1 year, it will continue to accrue interest. And so you need to pay interest again in the future. But when we talk about the interest payment due in isolation, once you have paid this year's outstanding balance, then during this year, you do not have anything to do with the lender. You do not owe the lender any interest. So from this perspective, interest, and similarly for dividend, it is of current nature. So this year's interest applies to this year only. Next year's interest, although they may be the same amount, is a different interest to this year's interest. And hopefully this is clear. But if you are still kind of confused about this, just remember that for debt or equities itself, it is have future obligations. For the interest payment, is with a current nature, does not carry any future obligation, because you do not generate interest on interest. I think that's another way to explain this topic. And the next sub-account, which is really not that important, is net secondary income. So this is things like foreign aid. There's really nothing to talk about net secondary income. And usually in the exam, you can safely just ignore this. I don't think they ever asked a question about net secondary income. So now let's look at the other side, which is capital and financial account, something with future obligations. It is also have many sub-accounts. So for the capital account, which is really not that important as well, and I think it's covered in one of the earlier exams, but as long as you can remember the definition, you should be all right. So the definition is capital accounts records acquisition of non-produced and non-financial assets. Between residents and non-residents. So I think this is really a confusing definition and doesn't make any sense. So an example is a patent. So the transfer of patent with money is basically an example of transactions recorded in the capital account. So by non-financial assets, anything with I think traded on the financial market is called financial assets. So debt or shares or cryptocurrencies, they are financial assets. For things like real estate, they are non-financial assets. And non-produced, I think, is referring to things that do not produce anything. So debt produce interest, equity produce dividend. But things like cryptocurrencies or gold, they don't produce anything. They don't pay you dividend. If you have 1 ounce of gold today, you have 1 ounce of gold tomorrow, and 1 ounce of gold in 100 years' time. So they are not producing anything. So as you can imagine, a patent is not traded, so it's non-financial asset. And patent itself does not produce anything. So one patent cannot become 2 patents in 10 years' time. So it is non-produced assets. So this capital account is really insignificant in terms of the amount of money involved. So don't worry too much about it. The important account is the financial account. So financial account is something that with future financial obligations. So it's divided into many sub-accounts as well. So it has something called net portfolio investment. Careful that everything is in net term. So it is, so in the case of investment, it's the investment that Australians invest in overseas countries, subtract the investment of foreigners made in Australia. So this is net investment. So it's called portfolio investment whenever you have less than 10% of ownership. So if you purchase $3,000 in shares of BHP, then it is called net investment, a portfolio investment. If you are an overseas investor, because for $3,000 you cannot get 10% of ownership of BHP. But one thing to be very careful with, if you are Australian investor and then you purchase shares in BHP, which is an Australian company, it's not recorded in the financial account, because for capital account, financial account, and for current account, we are only looking at transactions between countries. And similarly, if you purchased a product that is Australian made, it is also not counted in the current account. It is accounting system of, maybe I should say, international trade. And the second sub-account is called net direct investment. So this is just the opposite of net portfolio investment. If you are acquiring more than 10% of ownership, it's counted under net direct investment. Another account is called net other investment. So those are things like loans. Because if you invest in equities, it is represented as a part ownership of that company. So if you have purchased shares of Apple, then you become a part owner of Apple. But for loans, it's not ownership, it's just obligations. So Apple is required to repay you some amount of money if you borrow money to Apple. So this is counted under other investment sub-account. You also have net reserve assets. So this is usually not significant as well. So it's something to do with the Reserve Bank of Australia. And the last one is financial derivatives. Again, not something you need to be worried about for the purpose of the economics exam. So the three important sub-accounts are net portfolio investment, net direct investment, and net other investment. So this is basically all the sub-accounts you need to know for balance of payment. Or the most important feature is that if you add whatever number you have for the current account with whatever you have for the capital and financial account, they should equal to 0. So I will abbreviate current account as CA and capital and financial account as CAFA. You can also do this in the exam, so you don't need to write out it in full. So why do they add up to 0? As I have mentioned before, it is an accounting system. It is the creation of human mind. So we have defined the two accounts to sum to 0. So this is a part of the definition. And it is designed to add up to 0 as well. So there's really not a reason why they add to 0. There's no natural reason. It's just that we want them to add up to 0. And the system is defined in a way that ensures them add up to 0. So maybe let's try to understand this intuitively. So current account, it's something with current nature, does not carry future obligations. And capital and financial account carries future obligations. A good way to make sense of why these two must add up to 0 is to think about a related topic in personal finance. So we know that current account plus capital and financial account is equal to 0. The implication is any surplus in capital account means deficit in capital and financial account. So they add up to 0. Any deficits in the current account must be balanced by surplus in the capital and financial account. So why is this the case? So capital account records something that is current in nature. So you can think of current account as your income and expenditure. So both income and expenditure are current in nature. So you earn money during this year and then you spend money during this year. So suppose you are living beyond your means. So your expenditure is greater than your income. So this means you have a deficit in your personal current account. Then what would you do? So this is already a realization. So you already spend more than you earn. So this immediately implies you have borrowed money. So these two things occur simultaneously. So it's like if you are purchasing something on credit card, then this means you are spending money that you have not earned yet. So you are spending money, but at the same time you are borrowing money. So these two things, whenever expenditure is higher than income, this automatically means that you have simultaneously borrowed money. So it doesn't occur like step by step, it occurs at the same time. So that's the whole purpose of the balance of payment. So it all occurs at the same time. It's not that you have spent money you haven't earned, and then after you spend this money, you go out and then to borrow money. So this always occurs together, occurs in pairs. So when expenditure is higher than income, this means you borrowed money. And borrowing money, this is money coming in. So money is coming in, perhaps from your bank, from your credit card, and then you are using this money coming in, money you haven't earned, to purchase stuff. So this is a surplus. So surplus is money coming in via your personal capital and financial account. And as we will talk about later in the video, because you have borrowed money, you need to do two things. The first is repay this money in the future. The second is to pay interest. And interest is one of your expenditure items, because interest, as we discussed before, is current in nature. So if you are continuing spending like you have before and then you haven't increased your income, suddenly your expenditure becomes larger. And because of this, you need to borrow more. If you borrow more, you need to repay more, you need to pay more interest. And so your expenditure even increases further. So this cycle will continue. And this is in fact what happens to many countries. And those countries are in a very tough financial situation because of this. Conversely, if you earn more than you spend, so you are very frugal, then this means the income is money coming in. Expenditure is money going out. So if money coming in is more than money going out, you get a surplus in your personal current account. And then if you are spending less than you have earned, then simultaneously this implies you are saving money. So how do you save money? So if you have $100 in your bank account, what does this mean? This means you have lent $100 to bank. So if you're opening up any balance sheet of banks, you can see that your deposit is actually counted as liability of the bank because you are lending money to the bank. So money is going out because you are lending money to bank. And this means money is going out, so you have a deficit in the capital and financial account. So overall, these two things should always cancel out each other. So because any surplus cash you have made, the money has to go somewhere. The money itself represents an asset to you, but a liability to others. So if you are putting this money into the bank, then you are borrowing, or you are lending this money to bank. The bank is borrowing money from you. So the money is going out from your pocket into bank's pocket, and the banks will pay you interest. So this is essentially what happens. Many people, they don't think about this. So they think if you put money into your bank, it is your money. But simultaneously, the other side of the coin is that it is bank's liability. So you are essentially lending money to bank. And these two things should always cancel out each other. So hopefully this analogy is useful to you for understanding why current account and capital and financial account must add up to zero. Another definition I want you to be familiar with is the notion of debit and credit. Debit means money going out. Credit means money coming in. So in essence, import is a debit because money is going out. Export is credit because money is coming in. So this is from Australia's perspective. So now let's talk about a related topic, which is current account deficit. So traditionally, Australia has a current account deficit. And this is caused by structural and cyclical factors. So by structural, I mean some of the permanent features that causes the current account to be in deficit. When you have current account deficit, this means you have a capital and financial account surplus. And why is this the case? When you have a current account deficit, this is basically means you are spending more than you earn. And it must be, because you are spending more than you earn, so this must be financed by borrowing. And the borrowing is reflected in a surplus in capital and financial account. So money is coming in through the capital and financial account. So how can money come in via this account? You either issue debt, so you borrow money from overseas investors, or you sell down the equities of Australian businesses, so you can get money in. So for the structural factors, is the caused by low savings and high investment. So Australia's savings rate is very, very low. So it's around 5% of disposable income. So if you make $100,000 a year after tax, if you are saving $5,000, then you are basically at the average saving rate. So because of low savings, there's insufficient domestic savings to fund all of the investment opportunities. And so you need borrowing. So borrowing is required. And this borrowing is reflected as a surplus in the capital and financial account. And because you are borrowing money, this increases net foreign debt. And as we have already discussed earlier, interest on debt is a sub-account of current account. And interest, because it is money going out, is a debit item. So this means you have more debit via the current account. And this increases current account deficit. You can see there's actually a vicious cycle going on. This is the same as personal finance. If you are borrowing money, you need to pay interest. And because you are paying interest, you have less money to earn, but you are still spending the same amount of money as before. So you need to borrow more to fund your consumption. If you borrow more, you need to pay even more interest. So you need to borrow even more. So this circle completes as increase in current account deficits leads to even more borrowings and even more debit. So this vicious cycle keeps going on and going on. And that's what we define as the structural component of current account deficit. It is always there. Another cause of current account deficit is the low international competitiveness. So we know that Australia has high wage and low productivity. So this is not I'm making things up, this is a fact relative to other countries. So this means that Australian exports is not competitive. So if you go overseas, it is very rare that you can find anything that is made in Australia. And this is for a good reason, because Australian products are not competitive. So this means less exports. And if you go to any shop in Australia, you can see everything is made overseas. Very few things is made in Australia. So in other words, it helps to increase imports. Exports, as you know, is credit. So export is money coming in. Imports is debit. Imports is money going out. So you have more debits, less credits. So this means you have decrease in net goods, decrease in net services, and hence increased current account deficit, or causes a persistent level of current account deficit. So that's the structural factors. Now let's move on to the cyclical factors. The cyclical factors is always related to the business cycle. So during recession, we have low aggregate demand. And this means low inflation. Low inflation increases international competitiveness. A higher level of international competitiveness increases exports and discourages imports because price becomes more competitive. So this means you have more credit, more money coming in, and less debit, less money going out, and thus decrease current account deficit. During peak, you have very high level of AD, excessive level of AD. So you have high inflation. So this discourages international competitiveness and encourages exports, discourages imports. So this means you have more debit, less credit, thus increase current account deficit. The last concept we're going to talk about is net foreign debt and net foreign equity. So for net foreign debt is the net, also overall debt obligations Australia has to the rest of the world. So this is the biggest component of Australia's foreign liabilities. And because of net foreign debt, we need to pay interest. And interest is a debit item in the current account. So this is primarily the cause of Australia's persistent current account deficit. So if you look at the actual data, so we always have a deficit in the primary income, so net primary income. And sometimes we have surplus, or we have trade surplus. But because of this persistent deficit, usually when we subtract them, we have a current account deficit. Unless we get a really big trade surplus, when commodity price is really, really high, then potentially we can get current account surplus. But the central idea is the net primary income section, which is associated with net foreign debt, is always negative. So we're always overall paying more interest to foreigners than foreigners pay interest to Australian domestic bond. Also, we have net foreign equity. So this is basically the net equity obligations that Australia have to the rest of the world. So what the world own Australian equities minus what Australia own foreign equities. So actually Australia have a negative net foreign equity. So overall, Australians own more foreign equities than foreigners own Australian equities, which is opposite to net foreign debt.